much. Thank you everyone for coming here today. Hopefully it's a little bit different than you've been accustomed to for the rest of the day. And so briefly, I'm with Token Metrics. We are a sort of a multi-strategy firm. We've got a crypto research platform similar to Bloomberg, but for the crypto space. And we also had launched Token Metrics Ventures earlier this year. It's a hybrid quantitative investing and VC style hedge fund for which I manage all the quant team and the quant strategies. Given I've got a lot of stuff to go through, so it might be a little bit quick, but happy to answer questions after. The main thing I want to talk about is something called on-chain data and how it can be applied for quantitative investing in the crypto space. In legacy markets, you typically have time series data as well as inflow, outflow data, sentiment type data, and those are all used to gauge different ways of generating alpha. The interesting thing with the blockchain, the crypto space, is every transaction is recorded. So there's an entire history from beginning to end, movement of assets across the space, inflows, outflows, measuring capital in and out of different wallets you can consider accounts. And so you get a fairly granular look at what's happening in the space. And the challenge, and just as in legacy markets, is how do you take all that data and convert it into signals which you can use to generate alpha? So briefly about our team, we've got over 25, 30 years experience. We use AI deeply, both for researching the space as well as generating signals, but also try to apply AI in a way that can be digestible for both retail and institutional users. We've got a broad array of industry experts. We have a very wide network throughout the globe. We essentially travel as much as we can to visit different protocols throughout the world and find some really interesting ideas, not only in the space, but that can be applied in legacy markets. Some of the stuff that we've done in the space, basically we try to create baskets of indices that are retail based, which is probably just at least 10,000 or so users are interested in. Like in legacy markets, you typically have ETFs, baskets of ETFs, which comprise different securities. We try to replicate that in the crypto space, make it easy for users to find interesting investments and hopefully outperform. The interesting thing you can notice with this chart here is this is a monthly rebalance index on the KuCoin exchange and as well as the Binance exchange. One heavy outperformance, that's fine, but notice the drawdown. The drawdowns in this space can be enormous. And so the challenge that we have in conveying this type of information to a broad array of users is how to manage the drawdowns. 3 different rebalancing techniques, hedges, things like that. So that's what we try to convey. Similarly, we also use what's called Uniswap, which is a decentralized venue for swapping coins. Think of it as an OTC venue for swapping stocks, but in the crypto space. What we ended up doing is the challenge we had is there's 6,000 plus assets in this space, many of which are liquid and many of which frankly are garbage. But from a user perspective, you don't know that because there's not a centralized sort of venue to disseminate research. And so we built a platform that does both fundamental and quantitative research. And the challenge with the quantitative side was how can we take a broad array of data points and convert it into a single bit of information that we can convey to users to give them a sense of what is the estimated forward performance of various assets. And so we created what we call the TM grade, the token metrics grade, essentially a very quick way of gauging the thermometer of a particular coin, whether it's Bitcoin, Ethereum, Solana, Dogecoin, anything like that, to give an estimate of what is a high-graded coin. Our backtesting shows tends to have positive forward performance. Low-graded coins tend to have negative forward performance. And some other type of work we did, creating visual indicators, mixture of factor-based models, different quantitative approaches, a little bit of reinforcement learning in there, but essentially interesting ways of conveying signals to a broad array of users. Now, the main topic of today's discussion is on-chain data and how it's derived from the blockchain. The blockchain is peer-to-peer decentralized ledger technology. The key aspect is peer-to-peer. It's distributed to allow shared communications. It's because of the peer-to-peer architecture, every transaction gets recorded in the blockchain, every movement, and that's critical. One, it provides a high degree of resilience, for hacks and things of that nature. But more importantly, for our purposes, it's the granularity of the signatures created in the blockchain allow us to do not only forensic analysis if we were, for example, interested in any sort of nefarious activities, but also analysis that we can take this data and track movement of capital across the blockchain and give us an early read as to where capital may be flowing. In the same way that if we analyze from a macroeconomic perspective the flow of capital across the world to see is it flowing into the US, into Europe, is it flowing to bonds, equities, commodities, things of that nature. Kind of went over how the blockchain works. There's a diagram. Essentially, blocks are linked together. There's a hash rate involved. And the key idea is if there's any, the way the blockchain is constructed is if there's any modification in any particular block within the blockchain, it affects every subsequent block, and therefore the signatures break down, and we can tell that there is some malicious intent there. Now, on-chain data. As I mentioned, all the data is natively stored in the blockchain. This type of data includes timestamp, gas prices, miner activity, block sizes. And because the detail of every transaction is recorded, we get the from and to across the chain, and also smart contract innovations or invocations. Now, briefly, a few definitions. Inflow, what we're looking at is when there's centralized exchanges. Think of, well, there used to be more, but like the NASDAQ is a centralized exchange, the New York Stock Exchange centralized as well. And in the crypto space, there's different types of centralized exchanges like Coinbase, Binance, FTX. The problem is each of these exchanges typically trade the largest capitalization digital assets and other assets, but they don't necessarily overlap. And because they don't overlap, there's not a central way of essentially looking at data. One has to consolidate it at your end or through a third party. But the other interesting thing is we can measure when assets are flowing into an exchange or out of an exchange. And I'll go into subsequent charts why that's critical. Stable coins is a proxy for money market instruments in the crypto space. It allows us to get a sense, it's basically like a sentiment measure. When we see increase in flow of capital into stable coins, what we're seeing is essentially de-risking. In the same way that when we look at movement of capital from equities to bonds and vice versa, it gives us a sense of if we're in a risk-on, risk-off environment, or if we're looking at, for example, the Japanese yen, if there's an increase in flow into the Japanese yen, is it reflective of a risk-off environment because of things like the carry trade? So so when we first started looking at this type of data, typical data science, do the EDA, exploratory data analysis, try to get a sense of what's going on. Here's a graph of Bitcoin versus the total inflow into centralized exchanges across the exchanges that we measure. So is there some useful information? The spikes, like anomaly, we try to see, okay, do they correlate with any meaningful movements in price? Similarly, net outflow from these major exchanges, it starts to give us some information that, okay, perhaps there's some information we can derive from the movement in and out of exchanges, but is it, do we use a linear model? Do we use a multivariate model? Then we start to think of things like that. Similarly, stablecoin, we look at the ratio of stablecoins versus total assets in exchange. Is that giving us some idea of a risk-on, risk-off environment in the crypto space? The network value to transaction. This is a way of, it's somewhat similar to like the PE ratio in legacy markets, and gives us this indication of are there points in time when extremes in this ratio tend to correlate with extremes in crypto assets. Similarly, miner to exchange flows, another measure that we can use to get a sense of not only direction but also sentiment. When miners you think of it from the perspective of behavioral finance. The activities of miners is influenced by not only what they see happening in the markets, but also their forward-looking view. And because of the blockchain records every single transaction, the movements of assets out of and into addresses associated with miners gives us a sense of what is the sentiment from the miner's perspective. Similarly, exchangers to mine flows. Then we also have transaction fees on the Ethereum blockchain. For those of you who follow Ethereum, the gas fees or the transaction fees were enormous last year. So much so that small movements of capital could cost several $100s, which is, if you're going to do a transaction, imagine doing a transaction with a brokerage and suddenly, for buying 1,000 shares of Apple, your bill is $500. That's, doesn't really seem warranted. Now, the interesting thing is what we found is not the movement of the transaction fees, the gas fees itself, which was of value, but it was the volatility associated with them. Number one. Number two, for those familiar with NFTs, because of the way they're minted on typically Ethereum blockchain, the gas fees associated with them, because of the volume of transactions associated with them, cause tremendous congestion in the blockchain and therefore spike gas fees. So that doesn't always occur, but what it tells us that there are different parts of the ecosystem that need monitoring, not only the on-chain data such as this, but also what's happening, whether it's things like DAOs, NFTs, metaverse gaming tokens, things of that nature. So we try to look at the entire space, and when we build our models, essentially, create either multivariate, models if we're using sort of a linear approach, or different types of, combine different ML models because the space itself evolves. Similarly, transaction fees, the interesting thing is they tend to correlate with the volatility, which was a little bit unexpected, but when we kind of did some more forensic analysis, it also further correlated with spikes in NFT volumes. Hash rate, not too much useful information, essentially correlating with it. So, and total value staked. So typically in a lot of these crypto assets, particularly in the decentralized finance space, one way of attracting value is essentially, more think of it like attracting deposits into a particular protocol, and it's either for earning yield or earning transaction fees through staking, things of that nature, and these protocols more or less tend to correlate with an increase in the market capitalization of these type of assets tend to increase with TVL, total value locked. That isn't always the case, but historically it's had a relatively strong correlation. And finally, we took all this data in typical machine learning style. We define a problem statement. We would do a pre-processing, looked at correlation analysis, SKU analysis, oversampling to the degree that we needed to. And then we ran auto ML strategies, cross-validation, but we ended up, typically tend to do that as sort of a first run, just to get a sense of, what parts of sort of the ML ecosystem are offering value. And then from there, we do our own, independent analysis, essentially combine, multiple models. And we ended up, essentially creating, and then we did, when we did some further correlation analysis, what we found is that the Bitcoin reserves and exchanges tend to correlate very highly with prices. So if there's nothing else you wanted to look at, and you wanted to get a sense of what is the likely direction of Bitcoin movements into and off of exchanges, would give you a first level read on what is the likely forward direction. And we measured this in 1 week forward as well as 1 month forward. So if there was nothing else you wanted to look at, that would give you at least an interesting first read. And we find it to be relatively useful. Unstable, but relatively useful. Similarly with Ethereum, different sets of correlations, but interesting nonetheless. So we took this information, looked at what were the most important features across the space, using a feature analysis. What we found was, stablecoin ratio, inflows, as I mentioned earlier, as well as when we applied moving averages and other quantitative approaches for net value net value to transactions, and the estimated leverage ratio as well, which in this space, leverage, if you kind of keep up with it, leverage can be extreme. There's some exchanges which let you use 50 times leverage, which 2% down on assets. Even for futures contracts, that's quite low. But it's not uncommon in this space, and that of course accentuates moves in the upward direction as well as the downward direction. And so those were it's an important feature to track when we're trying to get some sense of what is like the forward likely direction. Same thing for Ethereum, different sets of features, but some of which were more useful than others. Then what we ended up doing, we created what we called an on-chain grade, and we took all of the features that were most important, both for Bitcoin and Ethereum. We focused on those two to begin with. Ran different models, very simple linear regression models, multivariate, and essentially created a set of models which more of an ensemble approach. But they're not, they were somewhat predictive, but then as we did further analysis and kind of fine-tune them, we were able to actually create a pretty interesting on-chain grade. And what the grade tells us is essentially, a high grade gives us high probability of future forward performance, upward forward performance, and low grade, weak performance. And similarly for Ethereum. Now, when we actually looked at the return distribution, given this type of analysis, what we found is that on typically high grade, meaning 80 or higher, on a scale of 0 to 100, we would, for Bitcoin, we would get 1 week forward performance in excess of 10%, and for low grade, around -6%. So we actually were able to roll this out as an interesting feature for most of our user base, both retail and institutional, to give them a 1 week forward look. And we've done it for longer time frames as well, and actually shorter time frames. We've actually gone down to essentially intraday, more high frequency type of time frames. And what we found is that the lower we go in terms of time, because of the lag in actually receiving this data, we get a lot more noise. So it tends to become less predictive in and of itself, which is not uncommon in the HFT space, but in addition to congestion and things of that nature. But it is actually relatively useful. And we did similar type of analysis for Ethereum, and a little bit better results. The 1 week forward performance with high grades was almost 20%, and for low grades about -15%. So that spread between we ended up actually creating portfolios like you can consider like ETFs, baskets of coins with correlated well to each of these assets. And roll that out as an interesting thing for the user base, and so far it's nothing is perfect. It's relatively good. It's a bit more unstable than we would like it to be, but that's part of the it's the nature of the business. Things tend to alpha decay, that tend to occur. So we tend to modify and adapt as we go forward. And but that's the essence of what I'm talking about. Here's some contact details if anyone wants to reach out. Fundamentally, the interesting thing about this space is like when I was talking with some of the people outdoors about some of the things happening in legacy markets. If anyone's followed, like there's a tremendous reversal in the U.S. market today. The crypto market was generally trading well early on, reversed as well. So there's still a strong, it goes through periods of time where there's a strong correlation. And when we look between legacy and crypto, and when we look at the actual on-chain data, which is what the essence of this talk was, we can see in the prior few days there was movement of assets off exchange, and other movements of assets on exchange. And what we found is when we essentially cross certain thresholds of movements of assets onto exchange, as a very simple rule of thumb, if there's an aggregate movement onto exchange, it's typically, being readied for sale. And if it's being readied for sale, there'd like to be forward weakness. And that is typical. We tended to see that about a little over 2 days ago. And we had somewhat of a reversal today. And when we look at the data as we come in, it tends to validate that. But it's a very interesting space. It continues to grow, but it's not for everyone. It's for high volatility, high risk. So with that, if there are any questions, I'm more than happy to